After the successful relaunch of the Silver Bullet Silver Shield series with Warbird last week, we are continuing the momentum with the introduction of Love. This opposite consciousness solution coin, done by Heidi Wastweet and produced by the ISO-certified Golden State Mint, is a beautiful reminder of how love will save the world. You can purchase Warbird and Love at stbullion.com.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Well, Eric, both gold and silver saw blatant cartel capping early in the week, ahead of Bernanke's testimony before the House and Senate Financial Committees on Wednesday and Thursday. The silver was repeatedly capped at the $20 level, and gold was repeatedly capped at the $12.90 and $13.00 levels. Gold actually briefly popped above $1,300 early in the week. And as we were discussing before the show, on Wednesday, when Bernanke's prepared remarks were released early in the morning, I think it was 8:30, the Fed released them, the gold market was actually up on the day and was trading up somewhat until the chairman actually came out and started opening his trap and spewing the mope verbally. Really not too much surprise to you or me or any of our listeners. Down went the metals. Really a classic cartel raid on Bernanke's Fed testimony. So what are your thoughts so far in the action in the metals this week, as well as Bernanke's testimony on Wednesday and Thursday?
Definitely an interesting week, and going back to that press conference as being a prime example of mope, metals not only were going up, but they were going up sharply prior to the London PM fix and just before and upon the opening at COMEX. And then it was only by the time the London session was closed that the cartel was able to come in and bash metals down. I mean, it was almost at the 2018 or so for silver when they showed up and executed a cartel waterfall for a good 70 cents. It's just telling when you look at what Bernanke actually said and how it was interpreted by the press. I mean, his written comments were true to the overall testimony and the question and answer session that he had before Congress, and the markets were reacting positively to it. I mean, the going expectation at this point is that the Fed is going to have to maintain liquidity, and that this whole discussion of taper is just nonsense. Even if they are to taper as an experiment, which is something I've speculated before, it's only going to be a partial reduction of additional liquidity. It's not a removal of liquidity, it's just a tapering, as they say. Slowing down on the gas pedal is an analogy that he loves to make. But one of the interesting things that happened was one of the questions had Bernanke responding about the conditions of the economy, and he said point blank, and I quote, "If we were to tighten, the economy would tank." And that comment was nowhere to be found in the United States media. I mean, it's just absurd. The Agency of France Press, Wire News Service covered that, and that is it. So
yeah, let's go back and repeat that one more time, because the American mainstream media was all reporting that Bernanke hadn't backpedaled from tapering. We're still going to taper. So go ahead and repeat that one more time for emphasis.
Again, Bernanke was quoted as saying, "If we were to tighten, the economy would tank." And tighten includes tapering. So it's absurd how the level of management of perceptions and so forth has been basically the operating policy for economic policy in the United States, and we really have very little else going on when it comes to strategies for improving the betterment of the economy overall. When in doubt, just issue a bunch of BS, and the write-up that we have on this week's show speaks to that. It's a sad state of affairs, folks, but really the Fed and central banks in general are supposed to be institutions that the markets have confidence in. Traditionally, if a central bank is not able to maintain confidence amongst market participants, they just lose ability to control the minimal levels of economic management that they have when it comes to setting interest rates and so forth. In this day and age, the Fed couldn't possibly do a better job of barbecuing confidence in the market. Every single week we have a flip-flop from be it either Bernanke or his cohorts on the Federal Open Market Committee and in their press releases and so forth. It's like, a bunch of chickens running around with their heads cut off, and this is supposed to be economic policy? All we can do is laugh or cry. I mean, it's just so sad.
You're right. It'd be humorous if it wasn't so sad for millions of Americans and what's coming.
Yeah.
I want to get into a little bit about updating listeners on the situation in the gold market. There's a couple big developments this week. We had the continuation of the negative GOFO or gold forward rates. They've been negative now, I believe, 10 days in a row. We have the 1 month, the 2 month, and the 3 month rates all negative. So really we're only waiting now on the 6 month and the 12 month until we have the whole set negative. But you and I were discussing off air, Eric, that this is the longest duration that rates have been negative in the history of the reporting. We were looking at a 25-year chart, and this is the longest duration the rates have ever been negative.
Yeah, and at least to the best of my knowledge, I mean, there may have been something way back in time, much further back, from data series that the doc and I have, we can't see that there's any other period where the duration, not the magnitude of a negative rate, folks, but the duration, the amount of time that we have sustained 10 negative days is off the charts, so to speak. And that actually is more important than a magnitude of a negative 4 or so rate on GOFO, because it speaks to the fact that the market hasn't been able to resolve the condition of severe scarcity of physical supply available. And that's what the GOFO is telling us. It confirms all of the other indicators all around the world, quite literally every indicator that you can think of that speaks to whether or not we have tightness in physical supply is signaling that we have a very tight physical market. We've got $30 plus premiums in Shanghai. Even in the Indian market, it's now becoming apparent to most people that they're going to actually have an increase in total imports over the course of this year, despite the fact of 8% tax rates and the more important fact of the government cutting off the ability for importers to actually get interbank loans to buy gold for jewelry manufacture and so forth. I mean, that's much more important than the tax rate. And COMEX inventories falling, London bullion market inventories falling. Doc will speak to the physical market in the United States. Everywhere we turn, the indications are that the market is tight. And the only reason why we continue to see pricing in the paper markets that's running counter to what we believe are the true fundamentals is naked selling of shorts, be it JP Morgan in the silver market or others in the gold.
Right. Before we get to an update here on the U.S. market, just wanted to continue on this topic here with the gold. A couple other things that have popped up this week showing of the tightness in the market. Earlier in the week, William Kay gave a pretty explosive and extraordinary interview to German financial journalist Lars Schall. And again, he's the managing director of the Pacific Alliance Group in Hong Kong, who made pretty big waves last week in a King World News interview where he came out and said that he owned the Bundesbank and the Federal Reserve's gold bars. But he came out and said that the purchase for really this now 3-month event in gold was to prevent all major bullion banks from defaulting like ABN AMRO. And he pointed out that this entire event happened within a couple of days after the ABN AMRO really default on their allocated gold accounts. And the news that just came out this week that we broke to the English-speaking press here. A second Dutch bank, Rabobank, has really followed in the footsteps of ABN AMRO. Maybe not quite to the extent, but is ABN AMRO. But they're going to close all customer accounts as of September 1st. Customers will no longer be able to acquire precious metals, and they're going to have, depending on your standing as a customer, you'll have either up to 6 to 12 months to either exit your positions or transfer them to another bullion bank. So really, Eric, just one more sign that, as we've been discussing, the physical market is so tight. Do you think this is, like William Kay was talking about, a start of the run in the bullion banks, or just signs of the tightness in the physical market? What's your thoughts on that?
It's a part and parcel of process of a run on the bank, something that has been evolving over the course of the last couple of months, so basically since ABN AMRO's announcement. I believe it was on April 1st when they delivered that letter to their customers. When we look at the decline in JP Morgan's inventories and the inventories on the COMEX and the oddness in the trading that we see with GLD and the reports that many of the people who were selling or pulling their gold out of GLD in connection to shares that they held. They were liquidating their shares, which would push the price down. However, they were taking delivery of the physical gold and storing it in warehouses outside of the COMEX system because they no longer trust the financial system. So it's not possible to know exactly how much of the GLD's liquidation followed that track, but there certainly was a huge percentage of that gold flowing in that direction. There are indications pretty much anywhere you look when it comes to these official inventories and their movements that suggest that the very wealthy and also the commercial banks, the bullion banks, are trying to figure out how to get their own nest eggs of physical gold in their own possession prior to prices moving higher. I don't think that's really much in doubt when you look at the whole picture, and then you see anecdotal bits of evidence like the story of bars with insignias of the Fed and the Bundesbank showing up in inventories current that are being delivered. That speaks volume. The story, I think, has been validated by the multiple points of reference that we can see across all of these various inventory movements.
I can't think of the name off the top of my head, but William K. has subsequently actually come out and confirmed the name of the refiner that he was speaking of at the time. But moving on to an update for our listeners and readers of the wholesale market here in the U.S., especially in silver. The shortage really has exacerbated and popped back up over the last 2 to 3 weeks as silver broke back down below 20 and has kind of stayed there for a couple of weeks until it ran back above 20 earlier in the week. But just looking through the supplier list, it really is amazing, and some of these things are unprecedented. We're, again, speaking off air, the 90% silver suppliers I'm looking at, and these are like the largest wholesale suppliers in the U.S., out of stock, 6 weeks delays, out of stock. There's only, I think, I'm seeing one supplier that has any in stock, and so we've moved past the extraordinary 1 month to 2 month delays. The wholesale suppliers are just out of stock of 90%, and that's pretty much unprecedented. And as far as the major mint coins, Canadian maples, they're running, depending on the suppliers, about 2 to 4 weeks on delay, really across the board pretty much. Premiums are, I'd say, pretty much steady with the past week. Silver Eagles premiums are creeping up a little bit, but again, it's the availability that is really the eye-opener. We're looking at really 4 to 6 week delays at most of the primary dealers. There's 12 primary dealers that are allowed to purchase from the U.S. Mint. And one of the 2 largest U.S. dealers is been completely sold out and out of stock for, it's going on 10 days now, and we've never seen this before in the history of, though we've had operations going at SD Bullion, we've seen delays, but we've never seen completely out of stock on Silver Eagles. When the mint is still supposedly minting them, and the mint hasn't shut down currently, so it just goes to show that the retail demand remains strong, stretching the supply lines, and really much more demand, and the retail supply system is going to break down in silver.
Yeah, and we should probably say a little bit more too about the 90% silver. For long-time followers of the silver market, 90% silver was traditionally, and we should back up, we should define that just so that newcomers will know what we're talking about. When we say 90% silver, it's typically the quote-unquote junk silver that is minted in 1964 or earlier, the dimes, quarters, half dollars, and dollars of the United States government. Back in the year 1999 and moving into year 2000, when everyone was freaking out about the Y2K phenomenon and the risk that posed to the economy, junk silver rocketed higher, whereas Silver Eagles and other traditional products did go higher, but there was nothing like the move to junk silver. Traditionally, junk silver is a telltale sign of what the hardcore U.S. buyer is thinking. And right now, with it completely sold out and one provider offering purchasability at a very long, I think it was 6 weeks, you had said, Doc, but with a $4 premium over a $20 price, give or take, that's like 20% markup, and that's similar to what we were seeing in the Y2K crisis, which is very telling. There is much less junk silver available in the market overall. It's not like something that is being produced as a new supply each and every year. But nonetheless, there's something to be said when we're looking at 20% premiums on junk silver and practically no availability for most suppliers, certainly when somebody wants to buy it in size. So, this is yet one an additional example of a tight market that, everywhere we look, the signals are all pointing towards higher prices at some point, and the charade that the paper markets are imposing on the physical markets can only go on for so long.
Right, it really can't continue forever. The gold rates can't be negative indefinitely. Something's going to snap and something's going to break, and it wouldn't be surprising if it's not soon. So.
And we've already seen psychologically Bernanke breaking mentally, so, maybe that's the telltale indicator of everything. his level of flip-flops as of late is, increased exponentially.
Right, I think really that sums up the week, that Bernanke publicly admitting at his press conference, point blank, I'm not sure how that reporter got some truth out of Bernanke's mouth, but Bernanke admitting that if the Fed tapers, things will collapse, what do you say, overnight? Pull it up for a third time, Eric.
He didn't say it overnight. He just said that if we were to tighten, the economy would tank.
The economy would tank. So we'll have to go with Bernanke on this one.
Right.
Might be the only time I've ever gone with Bernanke, but all right. I think that'll do it for this week. It's a good note to wrap it up on this week.
He did actually have one other gem that we should probably toss in just as a parting shot. In the congressional session, he did say, nobody really understands gold prices, and I don't pretend to understand them either. Well, frankly, I think that's a load of BS, because the gold price scares the heck out of them. Anytime it rises significantly, it destroys the so-called confidence that the market has in the Fed's ability to control the situation, and they're losing control, folks.
Yeah, as much as we're going to miss Bernanke, we're really going to already miss Ron Paul Bernanke banter at the sessions that we had this week with at the House Financial Services Committee.
Well, just wait. If they replace him with Janet Yellen, who's purportedly a much bigger dove than Bernanke, then maybe even Obama will appreciate that, because she'll be aggressive with the printing press, and he'll have better chances of getting reelected. And that'll be another story for another day.
Coming next week, we'll see if the gold forward rates can remain negative for 17 days, or if they'll snap first. But we always say next week should be interesting, but they keep getting more interesting. We don't need too much more interesting. So we'll wrap it up there. Tightness both in the physical markets, the retail side in the U.S., as well as signs across the globe in gold. Talked about India, the Rabobank as well, with closing the allocated customer account effective September 1st. The gold forward rates negative now for 10 days in a row. For the Doc and Eric Dubin, thanks for tuning in to the SD Weekly Metals and Markets.
SD Bullion.